The harsh reality of Forex trading, why 70% of traders fail, and how to avoid becoming a statistic. The Forex market, with its dizzying $6.6 trillion daily trading volume, is often portrayed as a golden ticket to financial freedom. Social media influencers flaunt luxury cars and exotic vacations, claiming their Forex secrets can turn anyone into a millionaire. But behind the glossy facade lies a brutal truth. Over 70% of Forex traders lose money within their first year, according to regulatory bodies like the US Commodity Futures Trading Commission, CFTC, and the UK's Financial Conduct Authority, FCA. Why does this happen? And more importantly, how can you avoid becoming part of this grim statistic? Let's peel back the layers of this complex, high-stakes world and uncover the psychological, strategic, and systemic traps that doom most beginners. The psychology of failure, why traders self-sabotage. Forex trading isn't just about numbers and charts, it's a battle against human nature. Here's why even intelligent, motivated individuals crash and burn. 1. The illusion of control. Many beginners believe trading is a skill they can hack overnight. They watch a few YouTube tutorials, memorize candlestick patterns, and dive into live markets with misplaced confidence. But Forex is not a video game. It's a zero-sum arena where banks, hedge funds, and algorithmic traders compete ruthlessly. Retail traders, often undercapitalized and emotionally unprepared, are outgunned from the start. Example, a study by the National Futures Association found that 40% of traders blow their accounts within 1 month due to overleveraging. A beginner might risk 10% of their capital on a single trade, only to see a sudden market swing erase their savings. 2. Emotional hijacking, fear and greed. The human brain is wired to seek instant gratification and avoid pain, a disastrous combination in trading. Consider these scenarios. Fear, a trader panic sells during a minor dip, locking in losses, only to watch the market rebound minutes later. Greed, after a winning streak, a trader abandons their strategy, doubles their position size, and gives back all profits in one reckless trade. Dr. Brett Steenbarger, a renowned trading psychologist, notes that emotions amplify cognitive biases, such as confirmation bias, ignoring signals that contradict your trade; sunk cost fallacy, holding losing trades in hopes of a turnaround. 3. The get-rich-quick mentality. Social media platforms like Instagram and TikTok are flooded with prop firm challenge ads promising six-figure payouts. These narratives prey on desperation, convincing beginners that Forex requires minimal effort. The reality: consistent profitability demands years of study, practice, and emotional discipline. Case study: in 2022, a popular prop firm reported that only 12% of traders passed their evaluation challenges, primarily due to overtrading and poor risk management. The systemic traps: how the Forex industry sets beginners up to fail. While psychology plays a role, the Forex ecosystem itself is riddled with pitfalls. 1. Broker conflicts of interest. Many retail brokers operate on a dealing desk (DD) model, where they profit from client losses, a clear conflict of interest. These brokers may manipulate spreads during volatile news events, delay order execution to trigger stop losses, promote excessive leverage, for example 500:1 to encourage risky behavior. Regulation matters. Always choose brokers regulated by authorities like the FCA, ASIC, or SEC, which enforce client fund segregation and transparent pricing. 2. The leverage trap. Leverage is a double-edged sword. While it amplifies gains, it also magnifies losses. A 1% adverse move wipes out your entire account. Yet, brokers often market leverage as a benefit to attract underfunded traders. The result? A 2023 survey by finance magnates found that 68% of traders using high leverage, 100:1 or higher, blew their accounts within 3 months. 3. Information overload. The internet is flooded with contradictory advice. Buy the dip versus the trend is your friend. Trade during London sessions versus focus on Asian markets. Beginners, overwhelmed by noise, often jump between strategies, never mastering one. This strategy hopping erodes confidence and capital. If you like this video, please subscribe. Breaking the cycle: how to join the 30% who succeed. Escaping the 70% failure rate requires a radical mindset shift. Here's your roadmap. 1. Treat Forex as a business, not a hobby. Profitable traders approach Forex with the same rigor as entrepreneurs. Create a business plan. Define your niche, e.g., currency pairs, time frames. Track metrics: win rate, risk-reward ratio, max drawdown. Reinvest profits, compound growth, don't withdraw earnings prematurely. Pro tip: use tools like MIFSpook or TradingView to analyze performance objectively. 2. Master risk management first. Risk management isn't glamorous, but it's the cornerstone of survival. Follow these rules. 1% rule: never risk more than 1% of your account per trade. Stop-loss orders: set them religiously, even if you feel the market will reverse. Risk-reward ratio: aim for 1 to 2 or higher. For example, risk 50 to make 100. Math check: with a 40% win rate and 1:2 risk reward, you'll still profit long-term. 3. Build a battle-tested strategy. Avoid paralysis by analysis. Choose one strategy and refine it. Trend following: use moving averages or MACD to ride long-term trends. Range trading: buy support, sell resistance in sideways markets. Breakout trading: capitalize on volatility after key news events. Backtest rigorously: test your strategy on 2 to 3 years of historical data before risking real money. 4. Cultivate emotional resilience. Even the best strategies fail without discipline. Techniques to stay grounded. Meditation reduces impulsive decision-making. Trade journaling: document every trade, including emotional triggers. Scheduled breaks: avoid overtrading by limiting sessions to 2 to 3 hours. Expert insight: Paul Tudor Jones, billionaire trader, famously said, "The secret to trading is to play defense, not offense." The road ahead: from survival to consistency. Escaping the 70% isn't about finding a secret indicator or copying a guru's trades. It's about accepting that losses are inevitable, prioritizing capital preservation over greed, committing to lifelong learning. Final thought: the Forex market doesn't reward intelligence, it rewards discipline. By mastering risk management, curbing emotions, and treating trading as a profession, you can transform from a statistic into a success story. Subscribe if you like this and want more.